Jaco van Jaarsveldt, who's the head of commercial strategy at Experian Africa. Now, I was looking at some commentary today from Maya Fisher-French, who runs the very successful Maya on Money website, and she's getting a growing number of emails from people saying, I'm really struggling to hold on to my home. And this is where it really matters here, Jaco, where the cost of servicing debt is elevated for such a long period of time that people have run out of any sort of elasticity in household budgets as prices generally have continued to increase. How are you seeing the household debt picture playing out?
It's a very valid point that Maya raises there, and I think after listening to your conversation with Kevin, it's important that we put context into the type of person or the segment of the market that's exposed to this interest rate pressure that you just discussed a second ago. If you think about the total value of outstanding credit in the South African market today is roughly 2.16 trillion rand, of which 1.6 trillion are secured lending products, and 1 trillion of that is home loans. That debt is owned, only 12% of South African credit active consumers have access to that type of debt. So 80% of unsecured lending debt sits in the hands of 12% of the credit active population, and those are the people that effectively are most impacted or are the ones impacted by interest rates. So interest rates, as severe as they are, is a small portion of the market is impacted by interest rates. More of the population impacted by inflation. But that said, when we look at the trend at which our consumer default index at Experian has deteriorated over time, we've seen it deteriorate significantly in the last 18 months. And in effect, it's a true measure of consumer distress when we measure through our default index. And it is looking at people that defaulted beyond 3 months delinquent for the first time ever. And we've seen a significant increase over the last 18 months. In fact, year on year, 70% increase in the most affluent segment of the market. And that is purely because of interest rates and secured lending exposure. And what we're seeing now is a similar trend occurring that happened in the late 90s, early 2000s, where the interest rates were around 21, 22%. And the first reaction there was from banks, repossess properties, let's go into the repo market, and ultimately banks just became the biggest holders of property that you couldn't put people in ever. What banks are doing now is they're unlikely to take back those properties because they learned from them.
Yeah.
So people struggling to hold on to their properties, absolutely, because of the cost pressures. But the advice would always be to consumers, go and speak to the bank. They won't make the mistakes they made in the early 2000s. And they're not going to take back because you just become a property owner. So it's very different, even though the trends look the same. Banks will react very differently to supporting consumers that's finding it difficult these days.
Yeah, I think you're right. Thank you, Jaco van Jaarsveldt, the head of commercial strategy at Experian Africa. Rather own up to the problem before the problem exposes you for having a problem, if you know what I mean. And so often, I talk to people in the banking sector and they know who's headed for trouble. They really do. And that's why the calls start coming in. And that's why you start getting calls saying, would you like a little bit of help? Would you like some counseling? Would you like a little bit of this? And rather come to terms with the issues that you may face in your life and your personal finances sooner rather than later. If you leave it too late, that's when the real trouble happens for consumers. That's when assets are taken. That's when things go badly wrong.